U.S. nat gas futures fell to around $2.65 from a three-month high as investors continue to monitor the amount of gas flowing to U.S. LNG export plants and weather forecasts. Meteorologists forecast the weather would turn from mostly near normal from June 20 to 23 to hotter than normal from June 24 to July 5, driving up demand for power generation used in air conditioning. On the supply side, domestic gas output is declining from the record level of 102.5 billion cubic feet per day seen in May to 101.6 billion in June. Ongoing pipeline maintenance activities, primarily in the Haynesville Shale region spanning Arkansas, Louisiana, and Texas, attribute this decrease. However, gas flowing to U.S. LNG export plants has decreased due to maintenance at various facilities, including Sabine Pass in Louisiana and Freeport LNG in Texas. For the week of June 10 to 16, nat gas storage levels increased by 95 billion to 27.29 billion cubic feet. Current inventories are 362 BCF or 15% above the 5-year average, while inventories are 571 billion or 26% above year-ago levels. Over the last 4 weeks, the natural gas storage surplus has increased by 22 billion cubic feet. After last week's surprise storage injection on the bullish end of the spectrum, market participants are again shifting expectations to a more cautious outlook. Fear of another rally from storage is fresh in the minds of these participants, and as heat begins to materialize, storage injections are likely to temper going forward. The short-term outlook for nat gas indicates an increase in demand, including exports. Anticipated hot weather is expected to drive gas demand from 94.2 billion cubic feet per day this week to 98.8 billion next week. Recent market movements have seen a 4% rise in U.S. nat gas futures. The increase in gas prices can be attributed to a decline in gas output and the anticipation of sustained hot weather, especially in Texas. Despite reduced gas flow to LNG export plants due to maintenance, prices have risen. Traders eagerly await the release of the government's weekly storage reports, as significant deviations from the consensus estimate could introduce market volatility. Overall, these factors indicate a bullish sentiment for natural gas, driven by increasing demand, favorable market movements, and the potential for volatility based on the storage report's figures. The short-term outlook indicates a developing downside trend. However, it remains above the 10-day moving average of $2.56, suggesting a bullish trend. The main support area is around $2.35, while the main resistance area ranges from $2.75 to $2.90. Based on the provided data and analysis, the market sentiment leans towards a bullish outlook. While summer weather hasn't hit its typical baking point across the country, cooling demand is inching up by the day, sparking the realization in the trade that higher price lows might be more common from here than new bottoms.